Hello students, I'm Dr. Panduranga Nayak, Principal, SVS College, Bandipal. In my previous video, you have learnt valuation of very many perquisites, including fringe benefits. Continuation of the valuation of perquisites, that is fringe benefits, we are going to deal with in this particular video. Let us start with some of the perquisites one by one. Expenses incurred to a credit card. So any amount of expense including membership fees and annual fees incurred by the employee or any member of his household and charged on a credit card provided by the employer or otherwise shall be taken to be the value of perquisites chargeable to tax. So credit card is provided by the employer. An employee incurs certain expenses like membership fees, annual fees and other expenses. The expenses might be incurred not only by the employee or by the member of any household, member of his household. Then the value of such services will be taken as the perquisite value chargeable to tax. Now, in case these expenses are incurred by the employee wholly and exclusively for official purposes, not for his personal or private purposes, then there is no taxable liability at all. That will not be taken as taxable perquisite at all. Where the expenses are partly for official purpose and partly for private purposes, to the extent it is used for official purpose is taken as exempt, whereas what is used for private purposes, that will be taxable. So these are the 3 points you must remember. Credit card is provided by the employer, and in that connection employee may incur certain expenses including membership fees and annual fee, or any member of his household may incur. Then the expenses incurred including membership fees and annual fees by the employee or any member of his household, that will be taken as the perquisite value of this particular facility, that is credit card. And in case these expenses are incurred wholly and exclusively for official purposes, then the perquisite value is nil. And if the expenses are partly for official purposes, to the extent it is for official purpose, that is exempt. Okay, now we'll move on to the next one, club facility. An employee might be a member of any club. If employer pays or reimburses any expenditure incurred in a club, including the amount of annual or periodical fee for employee or any member of his household, the actual amount of such expenditure is the value of perquisite. An employee might be a member of any club, or any member of his household might be a member of any club, and if the employer pays or reimburses any expenditure incurred in a club, then the actual amount of such expenditure is the value of perquisite. But if the expenditure is incurred wholly or exclusively for business purposes, the perquisite value is nil. Supposing an employee becomes a member of a club, but becoming a member of a club will help the organization or the employer to enhance the business, then definitely it is for official purpose, so the perquisite value is nil. And if this facility is provided to all the members or employees uniformly, the use of health club, sports or similar facilities, there is no taxable perquisite at all. So if the employer provides uniformly to all employees the use of health club, sports or similar facilities, there is no taxable park visit. Next one, use of employer's movable assets. Where the employer provides any movable asset other than laptops and computers for the use of employee or any member of his household, the value of the benefit shall be, there are two things. One is if the asset belongs to employer. The other one is asset is taken on rent. If the asset belongs to the employer, then how it is to be valued? 10% per annum of the actual cost of such asset is taken as the perquisite value. However, the value of perquisite for an asset used for more than 10 years would be taken as nil. Supposing an asset is purchased by the employer and the cost is 10 lakh, the perquisite value is per year, it is 10% of the actual cost. But if already the asset is used for 10 years and that is made available to the employee for use, then the perquisite value is taken as nil because already 10 years have expired after the purchase. Okay, next one is if the asset is taken on rent, then the actual rent charges paid or payable by the employer for such an asset. But from the value so determined, yes, the amount recovered or collected from the employee should be deducted. Then it will be concessional, not free rent. Free. So it is just concessional facility provided to the employee. Okay, this is about use of employer's movable asset. 10% of cost of the asset is taken as perquisite value. But then if the asset is already 10 years old, then its perquisite value is absolutely nil. And if it is taken on rent or hire, then actual rent or hire charges paid or payable by the employer, that will be the perquisite value. Once you ascertain the perquisite value, if any amount is collected from the employer, then it will be concessional facility. Okay, now next one is transfer of employer's movable assets. Transfer here means sale, exchange, etc. So movable assets, there are different types of assets. First we'll take up movable assets. If the employer transfers any movable asset to the employee or any member of his household, the amount determined by reducing the actual cost by 10% on the basis of straight line method for each completed year of usage is taken as the perquisite value. So you have to take the cost of the asset and depreciation for each year at the rate of 10% on the straight line method. Supposing the value is 10 lakh and depreciation is 10% of that is 1 lakh. So if it is used for 3 years, so 10 lakh minus 3 lakh, then 7 lakh is the value, is taken as the perquisite value. Computers and electronic items. Okay, other than household appliances such as washing machine, micro oven, mixie, hot plates, etc. Yes, in that case, the depreciation is calculated at 50% by written down value. So diminishing balance method. So under that it is being calculated. So reducing balance method or written down value method. So calculated at 50%. Supposing the value is 10 lakh. First year 50% means 5 lakh. So the balance is written down value is 5 lakh. Next year 50% of 5 lakh. So that way you have to calculate, reduce the depreciation and calculate the value. Similarly, in the case of motor car, it's 20%. Rate of depreciation is 20% per annum. So it is percent per annum. Okay. Yes. So 20% by reducing balance method. Supposing the motor car value is 10 lakh. In the first year depreciation is 20%. 20% of 10 lakh is say 2 lakh. The remaining balance is 8 lakh. second year depreciation is 20% of 8 lakh. So 1,60,000 should be reduced from 8 lakh. That way it goes on. So that way you have to value the per visit. So that's about transfer of employees' movable assets. Last one, sweat equity shares. If the following conditions are satisfied, value of sweat equity shares will be taxable in the hands of the employee. Point E. The security or shares involved are specified security or sweat equity shares. So here securities involved are either specified securities or sweat equity shares. Now, what do you mean by specified security? Specified security means security as defined in Section 2H of Securities Contract Regulation Act, and it includes securities offered under employee stock option plan. Whenever the company is going to issue the shares, so a certain percentage of shares might be offered to the existing employees. So that's called employee stock option plan. Employees may or may not subscribe to these shares. They have got the option. That's why it is called employee stock option plan. If they subscribe for shares, they are also part owners of the company. They are also not only employees but also shareholders. So the shares might be offered to them either at a free of cost or at a concessional value. We'll come to that a little later. So specified security means mainly employee stock option plan. If the securities are offered to the employees, they will be more responsible, they will be more committed, because if the performance goes down in a year, then their stake is also going to be affected. That's why this is one of the strategies implemented by the management by issuing shares to the employees under employee stock option plan. Next one, sweat equity shares. Sweat equity shares means equity shares issued by a company to its employees or directors at a discount or for consideration other than cash, for providing technical know-how or making available rights in the nature of intellectual property rights like trademark, or say goodwill, and that way patent rights, etc., or value additions by whatever name called. So sweat equity means it is issued to the employees who have exerted themselves to make the company a prospering company. In other words, they sweat out, they work hard to make the company a good company. So the success of the company or failure of the company depends upon the employees. Therefore, if the employees put forward more efforts, they sweat out, to compensate them, they might be issued some shares. We call that sweat equity shares. These might be offered to the employee either free of cost or at concessional rate. Yes, or sometimes instead of cash, they might be offered for consideration other than cash. Especially these sweat equity shares are issued to the employees or directors for providing technical know-how. Okay, some technical know-how might be provided either by the employee or the director of the company. Similarly, for making available rights in the nature of intellectual property rights. So that's an asset that will become an asset. So for providing that, they might be given some equity shares either free of cost or at consideration other than cash, of course at a discount. So that's about sweat equity shares. Specified securities or sweat equity shares are allowed to the employees by the employer either directly or indirectly, either free of cost or at concessional rate. Now, how do you value that? So you have to find out the fair market value on the date of transfer or when the employees exercise their option, and the actual amount paid or recovered from the employee. The market rate may be, for example, for 100 rupee shares, fair market value may be 150 in the market. Whereas you collect just 30 rupees from the employee per share. So 150 minus 30 and that means 120 is the concession, so that is the per visit value. So the fair market value of the shares or securities have to be found as on the date on which the employee exercises this option, as laid down by CBDT, Central Board of Direct Taxes, and the amount actually paid by or recovered from the employee. So the difference between that is nothing but per visit value. So by this I have completed everything as far as theoretical aspect of per visit is concerned. Per visits are concerned. So in the subsequent classes, we are going to take up problems, and we are going to solve some problems. With the help of that, you will be able to understand whatever I have taught theoretically. Of course, here and there I have given some examples, solved some problems, but we are going to solve some bigger problems which come under part C, which carries 16 marks. Similarly, part B, which carries 8 marks, and smaller problems in the case of section E, which carries, say, 4 marks. So thank you. So we'll take up some problems in the next video. Thank you.